a few notes about them and just a few notes about DSCR loans in general. DSCR loans, you mentioned the property type. DSCR typically is for single family 1 through 4. So that's perfect because it falls within there. When you get into anything 5 plus, it's considered commercial. So all multifamily that's 5 units or more is commercial. And most lenders will go like 5 to 10-ish units. And then at the lender that I work with for stack deals, they go higher. It's
Hi,
much
Lars.
Hey, Lars, welcome in.
okay. Can you hear me?
Yes.
Yes, sound
Okay,
good.
cool. Great.
That's where he is. Lars is at the beach.
I am almost. Hi, Tim.
Great to see you, man. I'm so excited for you.
Yeah, no, it's really exciting.
Yes.
Tomorrow's a big day.
You've
Yeah,
done a great job, man. I'm super excited for you. So
yeah, thanks.
I told him he made it very easy.
yeah, I mean, you were on it, man. You were on it the whole way through. Yeah,
Absolutely.
Lars, for those that are logging in here, who are in here right now, Lars is going to close. He's one of our next stack method deals that is set to close tomorrow. So
Woo! Yes.
Yee.
super excited. Yep. He's getting a
With
vacation rental property in Florida.
Yeah,
Yep.
it's exciting.
yeah,
Nice.
All right.
and
Just a
So
few more.
Marcella, I would say let people in, but no more note takers. I would just,
Yeah, I see some note takers coming in, so I'm
you
trying
don't
to.
need 10
Right.
different, well, we've got ours running. We can send it out like we always do.
Right. Exactly. Perfect.
Okay.
All right.
We may have a few more coming in, but let's go ahead and get started. We're glad you guys are here for our buying zero down Zoom. Man, I can't believe this is our fifth one already that we've had each Wednesday at 5:30, and it's been great. We've had some great conversations and we've shared some information. We've had some amazing questions. One of our questions from last week, was it Austin who asked the question, Marcella? Yep, Austin asked a question last week. Hey, how do you start the conversation with a seller to introduce this idea of a seller carryback? And we're like, that's a great question. So we're going to cover that next week. So if you come back next Wednesday, that will be our topic for next week. We'll be talking about, what's some good ways to start the conversation? How should you approach that with a seller to get them interested in this and how it's going to benefit them, right? Because they just want to know how's this going to benefit me. So hopefully we'll share some things, and maybe some people who have done these deals can also share their experience with how to get this conversation started with a seller who has the ability to carry back the down payment so you can purchase for zero down. But tonight, our focus is on DSCR lending because we have all the way from Denver, Colorado, our good friend here, Josh Trujillo. Let's give it up for Josh. He is going to be answering your questions and talking a little bit about what are the requirements and what's the best way to approach getting that DSCR loan approved so that you can get the loan, because you got to have the new loan and then you have the seller carryback note on top of that. And that's why we call it the stack method. There's two different sources of funding there for your property. So Josh, I don't know. I just want to open it up to you to maybe share some opening thoughts, and then we'll kind of open it up for some questions, and we'll take it from there.
Cool, definitely. Yeah. I mean, did you want me to just kind of give a rundown of DSCR loans and how I can assist in like the
Yeah, why don't
stack
you
method
start with
essentially?
the basics in terms of what is a DSCR loan? How does that work? And why would you get that kind of loan as opposed to like a hard money loan, or the basics, but then also specifically for stack method, what do you got to do to get one of these loans approved? That'd be great.
Yeah, and I was going to say, Josh, we have a mix of newer investors to the stack method as well as more experienced on here. So
Yep.
Okay.
perfect.
Cool.
Thank
Yeah,
you.
so I'm a mortgage broker. I live in Denver, Colorado, and I specifically focus on investor loans. So everything I do is either hard money, like fix and flip loans, bridge loans, ground up, or DSCR. DSCR is kind of like my main bread and butter, what I mostly focus on. And so a DSCR loan is an asset-based loan, just like hard money is, except it's going to be longer term debt as opposed to hard money that's 6 to 18 months usually. DSCRs are going to be fixed interest rate 30-year debt. And so it's similar to a conventional mortgage, except for it's more the property qualifying for the loan as opposed to the investor. The investor mainly influences things like their credit score, and their experience will influence things like LTV, so like how much percentage of the loan you qualify for, interest rate, and that sort of thing. And so it's really a good option for investors who are expanding their portfolio and investors who have issues qualifying using conventional mortgages. Because even somebody like a high income earner, a anesthesiologist who's making hundreds of thousands a year, they're going to still be capped by their debt to income ratio. And so that's going to influence how much they're able to gonna be able to borrow conventionally. And even in the conventional world, like you're limited under your personal name to 10 mortgages. And so that's Fannie Freddie guidelines. No matter which lender you go to, you'll still limited to how many overall loans you can have. And so with DSCR loans, there is no limit like that. So there's nothing influencing that or really limiting that. Like maybe certain lenders will only lend up to, let's say, 5 or 10 million per borrower until they've shown that they can perform on those. But really, you get into more dollar limitations. And really, the big thing with like a DSCR loan, the main thing it stands for debt service coverage ratio. And the main objective is that your rental income equals or is greater to the mortgage note. And so if it's equal, that's called like a 1.0 DSCR. If it's anything above like 1.25 would be higher income from the rental income than the note is. Anything below a 1.0 DSCR is technically negative DSCR, and so like a 0.75, for example, would be a higher mortgage note than your rental income. And so typically for best terms, you're going to want to, the higher the DSCR ratio, the better. And that's easier when obviously if you lower the leverage, things like that, or if you, lower the leverage, that sort of thing. And then really the the big qualifying thing is it like you could there's like for example, if it's vacant, we can still assist with vacancy. There's no issues there because you can use rental income from the appraisal. And so all DSCR loans rely heavily on an appraisal to get the value. And so that's really the judge and jury of a DSCR loan is more the appraiser and the appraisal than anything else. Like your credit score determines certain things, but the appraiser will judge the value of the property, and then all the numbers fall in line after that. And so there are options for no ratio loans where it doesn't hit 1.0 DSCR or above, and just you have higher terms, sometimes less leverage too.
Good. So that's a
Um,
great overview. And what I hear you saying is there's really no limit to the number of DSCR loans you can get. So if you're trying to scale and grow your portfolio, this is a great tool because it doesn't go against your personal credit, doesn't hit those, 10 loan limits, and it's based off of what the property can produce. Now, when they do
correct.
the appraisal, they're appraising not the value of the property, but the what the property can produce, correct? Or
No, the appraisal is going off the value of the property.
okay.
The So what's different, like for example, if a big trend right now is assisted living homes that are in a residential house. And they've come across my desk, and for example, one seller was trying to include the business income in the total valuation for buying the property, but
Mhm.
that didn't work for me because I can't include the business income. It's only based off the value of the property. So when they took the value of the property and added the business income, it was too high of an asking price to be able to make it work for us.
I
And so
see.
it's only the value of the property.
Okay, good. Um, does anybody else have questions? This is a great time to ask. If you have questions, you can just unmute and ask. Go ahead, Lars.
Yeah, so we're working another deal, and the seller has an equity of about 40% in that property. So if I take out a DCR loan with an LTV of 70% and I add 40% seller carry on top to cover, the purchase price and closing costs, etc. The seller could basically pay back his loan, but they wouldn't get almost zero. They would get almost zero cash at closing, right?
Right.
And so the seller wants to sell, but they haven't said yes, right? Because they're expecting, or they want some cash at close.
Yeah, I guess the
Uh,
question on that would be how much do they need it close? If they'd be okay with 5%, you might be able to make it work with a 35% carryback.
right, right. That's one menu. But the other question is, how much LTV could I get
Ah,
realistically on the DSCR loan? So if I say could get an 80% LTV, I could reduce the seller carry, and the seller might say, "Oh, yes, okay, that works for me." So,
So for
so
the
we're talking
stack,
about, maybe I should add, we're talking about a duplex, Florida Gulf Coast, used as short-term rental.
okay. Yeah, no, that's so the main lender that I use for all the stack deals, so a few notes about them and just a few notes about DSCR loans in general. DSCR loans, you mentioned the property type. DSCR typically is for single family 1 through 4. So that's perfect because it falls within there. When you get into anything 5+, it's considered commercial. So all multifamily that's 5 units or more is commercial. And most lenders will go like 5 to 10-ish units. And then at the lender that I work with for stack deals, they go higher. It's not really a determination based on the size of the property, more the loan amount. And then the loan amount on commercial is more determined by the debt service. So it has to actually debt service. And the max LTV that I can go for residential 1 through 4 and multifamily and mixed use is 75% LTV.
mm,
Mhm.
okay.
So I can get up to 75. And then I do have another lender option for doing stack deals, but they have to be structured like the preferred equity route where they own a part of the entity because that lender doesn't have sourcing and seasoning of the down payment money. Like it just has to come from a borrower's bank account, but they don't allow second liens. And so that's where it would have to be the preferred equity route. But the main lender I use, and even those guys are both at 75% on purchases.
So the one that does the preferred equity route, what's the cap on that one?
75%. They're both 75.
Oh, so it's still 75% the max you can get LTV. Okay,
Yeah,
loan to
yeah.
value. All right.
And what about the interest rate? So if I compare it with 70%, 75%, is there any?
It changes. So
It's
there's
changing.
buckets.
Mm,
So from 70 to 74.99 is that bucket. So if you're going to go to that, if you're going to get like 61, you're in that higher bucket. You're over 60, you might as well just get the max 65 because it's basically like
mm,
anything over, like if you're at 70.01 to 75, you're going to be in that range, and then 75.01 and up. So every bucket, so 70 to 75, 65 to 70, 60 to 65, and interest rates do come down. So the less leverage the less the lender is leveraged, the more the interest rate will come down.
mm, mm,
So yeah, the two big determining factors in interest rate is leverage, loan amount, property type, and credit score.
mm,
Those are the bigger determining factors. There are other things
Mhm.
in play that influence them, which are called loan level pricing adjustments. That's like the technical term for them.
mm,
And really, those are the bigger things. Other things can matter, like when you're getting into like you're just doing a cash out refi, your DSCR ratio on that. Things like your prepay term, like if the higher the DSCR ratio, the better rate you get. The prepayment penalty, if you buy that down, that's going to cost more and add to your interest rate, and cost points up front. And so there also too, like just a point on interest rate is like when there's more that goes into interest rate than just like taking it at its face value, because you could be comparing two interest rates and one could have exponentially higher closing costs because they're including a rate buy down on that. And so that's one thing to consider is like if you're doing a rate buy down and it's an extra 15, 20 grand at the closing table that you have to come in with, and you're saving $80 a month, it's going to take you years to recover that, and you'll probably refi before then. And so certain things, it's just like you got to take that into consideration and when looking at all the numbers together.
Mm.
And I get there's a lot of variables, obviously, Josh, but like just ballpark, what kind of range of interest rates are you seeing right now? I know it changes a lot and there's a lot of variables, but just for people who have no idea what they're looking at.
So for the lender I use for stacks, anywhere from sevens to like I would say like high sevens, low nines is kind of the range that I've been seeing depending on credit score. Credit score is really a bigger determining factor with them. Obviously leverage, but yeah, if you're just doing like a cash out refi, like if I'm not using that specific lender because we're doing like a more creative structure, and it's just like a traditional purchase with source and season funds, or if it's a refi, cash out refi, um, that can be a bit different. For example, like I can go higher leverage on a cash out refi, I can go up to 80%. And so there are more options. Rates come down a bit when we're not doing a creative structure. But it's just really with the few kind of hurdles that we have to get over as far as sourcing and seasoning, and then the seller carry, them allowing seller carries. That's where it kind of limits the amount of lenders that are able to actually get this done and know that you're not going to run into issues down the road, because you don't want to close the loan just to close it and they find out 2 months later that you have a second and they call the note due. That would not be a good situation for a borrower.
Right. We don't want to put our borrowers in that situation. So
So even like depending, even if I work with you, another mortgage broker, like you can look at the loan docs. You could even put it into ChatGPT, Claude, and say, hey, does this have anything about second liens, junior liens, subordinate liens, and look before you sign them and or before you record that note, just if you want to make 100% sure that you're not going to have any issues. Just because you don't want to avoid down the road issues that can become big headaches, even though they don't seem like a big deal now.
Mm-hmm.
great.
One
Anybody
more
else?
question.
Yeah, go ahead. No, Lars, go for it. It's great.
So, I've heard recently that if you plan on using it as a long-term rental, you get a higher LTV as compared to short-term rentals, at least with
So
some vendors.
it depends on the lender. Really, like I'm doing I have a lender that I use for short-term rentals that's the best that I like to use. Like I'm doing a cash out refi, or I'm doing a refinance right now. And we're structuring it as they can do 75 on cash out and then up to 80% on rate and term. And so it's not really much of a leverage change with them. If anything, it might be like a quarter of an interest rate higher than like a long-term rental. Like it might take a small or an eighth of a jump, but it doesn't really affect LTV that much, especially like the lenders that I have, like even the one that I use for the stack deals, they're technically all their 1 through 4 unit properties are no ratio. So it doesn't matter if you're doing short-term rental. Really, the thing to be careful with is if you're doing midterm rental, or sorry, if you're doing co-living, because lenders don't like a place that's rent by the room with like 7 leases. They would rather see one master lease and then subleases below that. And so doing certain things like that and structuring it from the beginning helps. But the lender that I use for the stack deals and the seller carry deals, they don't have any limits there. And so I can go up to 75% with them and use short-term rental, midterm rental. We can do co-living. We can make it work.
Okay, thank you.
Great. Good questions, Lars. Thank you. Yes, Det,
Hey guys, how's it going? This is Dat
welcome.
from Boston. So I'm pretty new to the process, guys. So I'm running a property management company. We manage like 100 units monthly, multifamily in the Chester, South Boston, right? And I'm also looking to buy multifamily for myself, specifically in Boston. So Josh, the stack method you mentioned about, so let's say I'm familiar with DSCR, meaning that you have to put like 20-25% down. So when you say that seller carry, are you guys referring that the seller gonna carry that down payment 20-25%, and then we're gonna bundle that into the deal? So I basically have no money down when it comes to closing. Is that how it works, or?
Yeah, let me answer that one. Basically, that's the whole point of the stack method is you get the DSCR loan or whatever kind of traditional loan, and then you have a note on top of it. The note is from the seller. You negotiate the terms of the note with the seller, and the
Right.
seller agrees to carry back. Now, what they carry back, let's say, like we said, what Josh said, 75%, you wouldn't have the seller only carry back 25%. You'd probably have them carry back like 30%, because that way you're going to cover your closing costs, you're going to cover your fees, you're going to cover your origination fees, all the different fees, right? So if the seller has the three things need to happen for a seller carryback. Number one, you have to get a new loan of some kind. That's why Josh is here. He's talking about the
A
DSCR
new
loan.
loan? I'm sorry, I missed it.
A new loan, some kind of a
Okay.
new loan. You can't do like a sub two and subject to somebody's existing loan. It has to be a new loan that gets originated. So you get a new loan. The seller has to be willing to carry back a percentage of
Yep.
their equity that they're going to get,
Equity.
right? So after they pay off their debts, there has to be enough there. And then the third thing is there has to be enough to cover that. So if somebody only has 20% equity and you're getting a 75% loan, you're not going to be able to buy it for zero down. You're going to have to bring some money to the table. But if they have 40% equity and they're willing to carry back 30 to 35%, and you get a 75% DSCR loan, then you've got enough to cover the entire thing. And in most cases, you put some money in your pocket. Now, granted, you're over leveraged, right? Because at that point, you're at 1.05, 1.1. But as long as you can cover the debt on the DSCR loan and you can cover whatever the terms are on the note with your income, you're good to go. And that's where the underwriting is so crucial. Does that help explain this? That's kind of in a
Yes.
nutshell what a stack method is.
Yep.
Okay.
Well, and to your point, Tim, too, like
Yeah.
I've done some deals where they're not necessarily over leveraged because they were able to buy below like ask like the ARV, and like I know that like technically the sale sets the price and the
Right.
market determines the price, but like if they know it's worth like 200 and they bought it for 180 or 190, then they might not be over leveraged when it's all said and done. So there are ways to do that. But typically, yes,
Yeah.
you're going to be slightly over leveraged because you're financing the closing costs
It's
and
kind of like
the
getting
transactional fee.
you're right, Josh. It's kind of like getting instant appreciation. If you buy something below market value, even though that's the price. Now the appraisal has to come in though, because here's the thing. The lender, and this is something we have learned, is that when they do the appraisal, the lender is going to loan on the lesser of the two, either the purchase price or the appraisal, whichever one is
Mhm.
lower. Okay, if the appraisal is lower, they're going to loan on that. If the purchase price is lower, they're going to loan on that. So that LTV, that loan to value, is based on the lower of those two. But Josh is absolutely right. If the property is worth 1.5 million and you buy it for 1 million, even with the seller carryback method, as soon as you own that property, it's worth 1.5 million. So you get instant appreciation. So you're really not over leveraged at that point if you get a really good deal on the price.
Yep, exactly.
Great. And we're glad you're here, Dan. Thanks for jumping in. Yeah. Anybody else? Questions or deals at this point?
And I just wanted to clarify with Lars, because I know you had emailed us some numbers. Are you feeling more confident about like your next move with this property and how that could possibly work?
So you're referring to the new deal.
Yes,
Yeah.
exactly. So yeah, absolutely.
Yes. I mean, I've been looking at this property for half a year now, and I'm in touch with the seller's agent, and he's trying to, be a good partner for everyone. It's just the seller is, they haven't said no. They're thinking about it, but they're kind of hesitant. And I think the next move is simply to say, hey, what about, we reduce the seller carry and you get X amount at closing. So could be a way forward.
Mhm.
Um,
Yeah.
Yeah, that's a great question, Dad. I mean, if you're willing, Lars, Dad's asking if you can break down the deal. I don't know how comfortable you are with that. We could always whip out a calculator. So I know we don't mind doing that either. So yeah, it's up to you.
So you want to show the spreadsheet or?
Well, we were just gonna, yeah, maybe since that's new, we could just pull up the calculator and just throw in some rough numbers based on what we're talking about with your deal, if that's okay.
Yeah,
Let me go ahead and
maybe without the property address, but
there's no address on this, just numbers. We got you covered. We got you covered.
Yeah.
Okay, let me get in here real quick.
Perfect.
Pull up.
Welcome in, James. You're just in time for the sample underwrite.
Okay, I'm gonna just, oh, I can't do that. Okay, where is my blank one here? That one I'm not able to make. Huh, interesting.
Josh, real quick while we're waiting, with those lenders that you work with, are they doing mostly soft pulls on the credit?
No, it's a hard pull.
It's definitely a hard pull. Okay.
Yeah, it's a hard pull every time. And honestly, like a hard pull is like for these, from what I've been told, they last like around 30 days.
I see.
So like 30, 40 days. So it's not as big of a deal. Like it takes a temporary hit. It's not as big. It's not like
Yeah.
some things like utilization, which will drop you until you pay it, until your like utilization comes down. But yeah, it is a hard pull. And so the good thing is with a lot of lenders that I work with, I could essentially pull the credit and then transfer the credit report in. And so the lender that I do stack deals with, that they're one of the one that I can't do that with, but most other lenders that I work with, they're one of like two that they require that they pull credit. A lot of the lenders I can pull credit and then I can transfer it to any lender. So like I'm working with a guy, for example, I'm doing a ground up construction loan for him, but he also has two DSCRs. So it made sense for me to pull the credit so then I can use that same credit pull for the next, I think it's 3 months. And I can take that to other lenders now and not have to keep repulling his credit to do more loans with him.
Yeah,
Right.
that's
a
smart.
great service you provide there. Okay, let me share the calculator here.
Okay.
Can everybody see that screen?
Yeah, let's do a thumbs up reaction if you can. I know I've got my
Good to
thumbs
go.
up.
All right.
So that's actually not the example I sent
No,
over.
these aren't your numbers. I just pulled up a generic one and made a copy
Oh,
of it.
okay.
Oh, okay.
Yeah. So
Lars is like, that does not look right.
I'm gonna change your numbers. So tell me what the asking price is.
1.599 million.
1,599. Okay, so we got the price in there. We're looking at, well, 75%, I guess, is what we're talking about here, LTV, right? So,
Well, yeah, so typically I start with 70%.
okay, we can do that.
Yeah.
And then,
Let's see.
what does the seller owe? Do you know that amount? Or we can
So
figure it out.
roughly 900,000.
Okay, roughly, we'll just put in 900,000.
Yeah. And with that 70%, I was asking for a seller carry of 580.
580. And there we go. So
There we go.
it's feasible. And again, I don't know, closing costs vary a lot. We can adjust this a little bit. I don't know that 5.8 is
Yeah,
exact.
so
Probably more like 3. Is there a realtor involved? What's their commission? Is that going to be a 3?
right, that's 3%, yeah.
Okay. So we've got
And
that.
I had 2.5% for seller closing costs, but
Okay.
I don't
No,
know.
that's fine. I love it.
And
Closing costs on the buyer side,
2.5.
2.5. And then what kind of origination fees are we looking at, Josh? Help us out here.
It's so I have a more of a number that I think like because a lot of the loans I work on are like 2 to 400,000. I would say like around 12,000 in that my all in cash to close that I give as an example includes everything from like my broker fee, lender fees, and all impounds, like a guesstimate on like taxes, insurance, those escrow impounds that you have to do. So that's like an all in number.
So would 2% be fair?
What's
Or
the
should I make that a little
loan?
lower? Because that comes out to 16,790.
What's the loan amount on that one? Let me do some math.
The loan amount is 1.119.
Let me see. I would do a little lower. Oh yeah, no, I would say yeah, 1 million. I would probably do yeah, 2.5.
Okay, well, let's just do 2.5 so that we're not, I'd rather
Oh, that's yeah. Okay, it's gonna make
too
you go through because
much.
27's a little high. Yeah, I think that might
Okay,
be a
well,
bit
how
high.
about 2.2? Let's try that.
Hmm.
Okay, yeah, that's a better.
All right, so here's the bottom line. It's definitely doable. You can see here, Lars would put 22,000 in his pocket. The downside is the seller's only going to walk away with 31,000, and that's the negotiation I think that needs to happen is how much do they need, right, in their pocket.
Mm.
You
Mhm.
can always, change the seller financing slightly and give up a little bit of your money in your pocket to put a little bit more in their pocket. So let's say we want to put another 10K in their pocket. Let's just change this to 570 instead of 580. And then that gives them 40,000, might be a little more appetizing than 20,000, and you end up with 12,000. Again, this is how you can kind of adjust the numbers and kind of see what might work and what might be a good offer. But it definitely, pencils out, and it could work. It's just a matter of negotiating with that seller and seeing if they're okay with only getting 40,000 at close and getting the other 570,000 over time on the note, whatever terms are agreed
Mm.
upon.
Yeah.
So if you just as an example,
Yeah,
use 80% LTV. Okay, it's probably not going to happen, but just as an example,
sure.
um,
Now we can
you could,
definitely bump down the seller carry amount and bump up what the buyer's going to get because you've got a
right.
lot more to work with right here. We could
Yeah.
probably do 470, and now we're
So so
doing more.
theoretically, you could do 400, right?
You could probably do 400. Yes,
So, and now that probably would make the seller more
I would say the seller
comfortable.
would be a lot happier to get 200,000 at
Mm.
close with 400,000 on a note. And that now this doesn't put much in your pocket, but if you've
Right, right.
underwritten it properly, you're going to be fine. And you're over here far on the far right, you can see the leverage ratio is 1.05.
Yeah.
And that's in terms of the two loans combined versus the purchase price. So yeah,
And to your point, Tim, too, whenever anybody is working on one of these and you need to know where you're going to be on the DSCR portion, if you're working with me, I can get a term sheet to you same day very quickly. That way you at least know, cool, here's my total origination. Like you can calculate all, and then you'll have a way more accurate of an
right.
idea of where you need to be with the seller.
Yes,
Because this
that's
is a
excellent.
guesstimate right now.
Yeah, this is really rough numbers, and this is not meant to be any kind of underwriting or anything like that. Definitely get the hard numbers from Josh or whatever lender you're working with, and do your own crunching of the numbers. But this gives us a rough idea and it shows us what can be done. Let me do for grins here, Lars. Let me do 0.75 and see how
Mm.
much we can get in their pocket. Okay. We're gonna have to come down a little bit here, so looks like we're gonna have to do about 475. Let's see.
Probably
Ooh,
480.
almost
Yeah.
480 is going to do it.
Mm.
So it is possible with a 75% loan to value on the DSCR to give the seller 131,000 at closing and still put a very small amount in your pocket, but buying a property for zero down.
Mm.
It's doable at 75%. And I don't know, how much do they need? That's the question I would ask probably. And we're going to talk about that next week. What are some of the questions you should ask the seller to kind of find out where they're
Yeah.
at and how you can approach this and how you can structure this so that it works for them and it works for you. But yeah, how much do you need at closing?
Mm.
Um, is a great question. So, all right, well, cool. That was great. I appreciate, Lars, you being willing to share those numbers. Josh, thanks for your help on that. And I hope that was helpful. Did that help you out? We can send you a free copy of that stack method calculator so that you can, play with the numbers yourself. Okay. All right. Anybody else have questions for Josh or for us?
Guys, I have a question. Yeah,
Yeah,
I have a
go
quick
ahead.
question.
Yeah.
So let's say, so Lars, do you have like exit plan for that? So let's say the seller is going to carry the note, right? So what term would be appropriate? Are we gonna have like a balloon payment?
Yeah.
So what is the strategy? Are we gonna increase the NOI so that we can refi them out? So
Right.
like, what is your strategy there?
So, so first of all, I consider it as an expensive property, right?
Very expensive.
Yeah, it is
Lars, look
1.6
into
million.
Boston,
It's a lot of
1.2.
money. However,
Yeah.
these properties are located just 200 feet from one of the greatest beaches on earth, right?
Okay.
And as soon as the market picks up again, because the market, it's a buyer's market, right?
Right.
As soon as the market normalizes, this property will be very easily above 2 million, right? In the next 3 years. So yes, we agreed on well, I'm not talking about the property we're closing tomorrow.
Yeah, sure.
We agreed on a balloon payment in 5 years,
So
right?
5 years.
And at that point, or before that, I'm gonna refinance and basically pay the
remaining
sanitary
repayment.
note off
Right, okay.
and just live with another DSCR loan.
So let's say what is the rate that he's going to carry? In like 4, 5, or it's up to open to negotiation? Because
In that case, we agreed on 4.3%, which is pretty good. I think it's not excellent, but typically most sellers want more, at least like on the 6% from what I heard.
right.
But I start low, right? So I made an offer on another property and said I'm gonna pay you 3%, and they said no. Which made me increase it to 4.3%. Why 4.3%? Well, it needed to be higher than 3%. And I guess it's more like a feeling. You don't offer 4% or 5%, you offer 4.35% because that seems like you did the math on that, but in fact it's really just something I can live with, and the seller thinks, oh yeah, so he thought long and hard about that interest rate, and so it was a little bit of a gamble, right?
So would you say that with the note as being at 4.35 and the DSCR interest rate 75% at, I would say 7%, would you have like a positive cash flow every month, or you have to suffer a little bit and carry
Yes,
it into 5 years?
so in the very beginning we'll be around break even.
Okay.
So a small positive cash flow.
Okay.
One
Yeah,
thing
no,
too, to like when you're talking about balloons, it's good that you did a 5 year because most DSCR loans will have a 5 year prepayment penalty, and it's
yeah.
typically a 5% on year one, 4% on year two, 3% on year and so on. And so then by the sixth year you're free. So if you do a 5 year balloon, by the time you go to refinance them and the DSCR loan, because you'll have to refi that out, you won't run into a prepayment penalty. You can
Right.
buy that down. It's more expensive too, but yeah, if you only negotiated a 3 year balloon, you obviously have to pay a prepayment penalty or buy it down up front, and it's usually half the price to buy it down up front as opposed to pay the fee later on in the loan.
And so for the DSCR loan, you basically have to live with what the lender will offer you. and the seller carry is absolutely negotiable. And you need to assess the situation, how desperate is the seller to sell. And I would just start lower. Say you can live with 5%, start with 4%. The seller will get back to you, says they want 6%, and you agree on 5%. But I guess most sellers want a typical, typical interest rate, like 6% or something. But then again, every case is different. Right?
I would imagine that so your filter, the seller equity have to be more than 30%, right? To make this work.
Yeah.
At
Just
least
typically,
30.
yeah.
At least
At a minimum.
Yeah, at least 30 to make it work.
Mhm.
If you're getting a 75% DSCR, because you need that
Yeah.
30 to cover the closing costs, the transactional lender fee, all of that.
Right.
Right. Okay. Thank you, guys.
Great. Hey, Lars, thanks so much for sharing. And you know what? I'm going to ask you, please come back next week because you would be a great resource for our how do we start talking to sellers, right? 'Cause you've done this. You've done this, man. So if you're available, we'd love to have you back next week
Yeah.
to help with that discussion. That'd be great.
Okay,
Yeah.
yeah, I'll
For
try
sure.
to
And,
make
and
it
I would
possible.
say, Lars is closing his first with us tomorrow. We're so excited to help him close that and move forward and
Yeah.
on to other bigger dreams and goals that he has. But one thing I can say is that Lars has asked a lot of questions,
Mhm.
which is how you learn, right? You learn by asking, and that we appreciate you doing that as well. Don't be afraid to unmute. Don't be afraid to put a question in the chat. We're all here to help. And it's a learning process, right, Lars? It's a learning curve.
Oh yeah,
And, our team is really big about that component of it, about communicating with our borrowers and helping them to understand what the next steps are. I mean, even back in, was it October, Lars, or September, we started talking about that whole LLC,
Mhm.
the holding LLC, and then going into the LLC and how we wire funds. And so, but this was back in September, I think,
Yeah, it's been a while. So
right.
the property will hopefully be closing on tomorrow. I think
Yes.
our first walkthrough was in November,
Mhm.
Yeah.
right?
So to
And
get an idea of the time frame, right? These are
yeah.
not like it's a process, right? And so understanding every component of the process, like that's why we have Josh on here tonight. Please ask him your questions, and try to get clarity on, how do I qualify for a DSCR loan? What are the steps I'm looking for? Obviously, like that said, you're looking for a property that has equity. You're also looking for a seller that is motivated,
Mhm.
right? They have to be motivated. They have to be open to terms, right? They just have to be open to terms. And one of the easiest ways that we start this process with any borrower is just submitting a letter of intent, showing those terms. That's all we require for submission on our website to get the funding process started with our team, right? So we have a full team ready to go and help, and Lars has experienced that. We've got an attorney. We have TCs that know how to do the stack deal or Morby deal, depending on the world that you come from, right? And so we already have a team set in place. And so they have the experience. It's interesting, some of the conversations, and I know Josh can attest to this too, where they'll say, I have a TC, I'm good. I've got a TC, and that TC, however, they may be experienced, right, in certain transactions, but to do a Morby method, for those of you who are part of PACE's communities, also called stack deal, our team calls it stack, but Morby is the same thing. Seller carryback financing is the same term. Those are all the same terms. And I love that Dad's like shaking his head. Yes, I can see that. So it's like, now that makes sense, right? So those are all interchangeable terms, but not every TC has done a Morby, right? And so knowing that Lars is working with our team for that reason, we have the experience, we have the attorney already ready to go. We fund in all 50 states. Right? So,
Great.
so yeah, I just
Well,
wanted to
and
clarify. Yeah.
to
Go
to
ahead.
add to your point, Marcella, about the like persistence is all of the borrowers that I've worked with who have been successful and had deals actually close, they don't just submit one or two, like they are constant, it's a volume game. They're constantly uh submitting leads. I give them a term sheet, they negotiate, and it sometimes it just falls apart. Like there's so many moving parts to these that there's a seller, a real estate agent, sometimes a wholesaler, sometimes the DSCR lender, the transactional lender. Like there's so many moving parts that the more you just push volume through it, you'll eventually get to that one that works out where all the stars align and the numbers all work out and everything works out. But it does take like I probably price out like 10 to 15 scenarios with a borrower before one works out. Just and it's not their fault. It's just that there's so many moving parts that for it to actually work, it's definitely a numbers game. So you just have to stay persistent and just keep negotiating and keep trying out all the scenarios that you can.
Yes.
And that's great. You guys are hitting it right on the head. I just want to add one thing to what Marcella shared, and that is, a lot of people when they're brand new to this, they're used to traditional locking up a deal, let's get a purchase and sale agreement signed, and they want to put the language of the seller carryback into the original purchase and sale agreement. We have found that almost never works. So what we always encourage is keep the LOI and the seller carryback terms completely separate from the purchase and sale agreement. In fact, our team, our back end team, the TCs have told us they would much rather you just start with a signed LOI with no purchase and sale agreement whatsoever. That way they can help you with that paperwork and do it right so we can keep those two transactions separate. When you try to merge those two, it's like crossing the beams in Ghostbusters. It never works out well when you do that. You don't want to cross those two things and try to have the seller carry back in the purchase and sale agreement. It confuses the title companies and it causes problems. So yeah, just start with that LOI, get the terms, and like Josh said, talk to your lenders, find out, do the numbers work out? If they don't, keep looking. They're out there.
And I want to say thank you to Marcella and Tim for, guiding me, guiding us, well, my wife and I, through this process, through our first deal. And there are sure many questions along the way, and Tim and Marcella were always very quick to reply and jump on a call and explain everything and have suggestions and tools and it's been great working with you guys.
Lars, we appreciate you so much. You've been the best borrower. Just like Marcella said, you not only have you asked all the questions up front, so you knew what you were doing, but you have been very diligent, in terms of, all right, this property didn't work out. Let's try another one. Oh, all right, this lender didn't work out. Let's try another one. And it's a lot of that trial and error that's gotten you to this finish line. We appreciate that. And I would just say, this is an invitation for everybody. You can go to our Calendly and book an appointment with Marcella or book an appointment with me. We're very happy to get together with any of you one-on-one and answer your questions and look at deals. That's why we're here. This is a more of a community Zoom that's open to everybody to come in so we can have certain topics and discuss certain things and have amazing guests like Josh over here bring us extra value. But that doesn't mean you can't book an individual appointment with us on our Calendly link. So please do that if you have questions. I think I also put in the chat, if you guys, I don't know if you saw it, I put the link for the stack method calculator. So if you don't want to wait for an email, go ahead and click on that link and make your copy right now, and you can get your stack method calculator there, and have that available when you're kind of penciling out whether or not it's going to be zero down or not. Again, not a complete underwriting, but a rough sketch to get you started.
And I
And I was
put
just
in
gonna,
the
oh, sorry. Go ahead, Josh.
sorry, I was just gonna say I put my email in my website. So if you guys
Perfect.
ever have any questions, shoot me an email, or on my website you can schedule a time for a call. Or you could submit a loan inquiry on there. So
Perfect.
Awesome.
that's all the
Perfect.
resources on my end.
Yeah,
Well, we
perfect. I did
appreciate you,
put our,
Josh. Thanks for coming in and answering questions and giving us the overview on the DSCR loan. That's been very helpful. And we appreciate everybody coming out. I'm just going to any final questions? Anybody has a burning question before we call it a night?
I was going to just add too, I did put our Calendly link in there for those of you who are new in here. Welcome. We're happy just to jump on a Zoom with you, even if it's just 15 minutes of your time. You can book a time there to meet with us, ask any questions, or text me. I'm actually going to put, you've got my phone number here on here, but and my husband's as well. Reach out, text us, and let us know how we can help. Okay. Go from there. So great. Thank you all for being here. Lars, it was a pleasure. I will be congratulating you again tomorrow after 9:30 a.m. So yes. So excited for him. Actually, it's kind of funny. We get to meet Lars in person because we're going to be in that, traveling to that neighborhood, that area this summer. So we're super excited that we get to meet him in person.
We
And
want a tour of your new property.
yes, that's the other thing. We're gonna take a video of everything that everything he bought and all that he went through. So we're super excited for that
That'll be
as
absolutely.
well. Yeah.
Well, it starts tomorrow because I just heard that the seller, they left all their old furniture in the house.
Oh.
So
That might be
That's
good
just-
or bad. That might be good or bad. We'll see.
Yeah,
Right?
I'm not sure which one that is. Depends on what kind of furniture they have. Right.
Right.
No kidding. And Joshua, thank you for being here.
Yes, Josh, we thank you
Yeah,
so much.
thank you for having me. I appreciate it.
We'll be in touch for sure, and we'll probably have you back again in the future. I appreciate you so much. Thanks for coming in. Hey, next week we're going to address the topic of how do you start this conversation with the seller? You know, what do you say? How do you get it going? I mean, you may not be afraid to get on the phone, but you might just not know how to start that conversation. So we're going to be talking about that next week. We hope you all can come back, invite a friend to come and join us. Please go to our Calendly link for the Buying Zero Down and register for that, so we know that you'll get a link and be able to join us next week, same time, 5:30 Pacific time. We will see some of you then.
Awesome.
All right.
Thanks,
Oh,
guys.
and
Bye.
one more thing. Just sorry, you will get a recording. If you've been on here on our Zoom, you will get an automatic email with the recording of tonight's Zoom. So
And if it doesn't come through automatic, I usually send out a follow-up email within the week with the new link and also the Fathom recording, so people can go back and check it out. But anyway, again, thanks so much for everybody coming out. What a fun meeting. Hopefully you got some value out of this, and we will see you all next week.
bye, everyone.
See
Bye.
you.
Have a good night.
Thank
Have a
you.
good night.
Bye.
Thanks, Lars. Appreciate you.
Thanks for coming, Bruce.